For your money time now, we're joined by David Nelson, CEO of Nelson Corp Wealth Management. David, welcome back.
Good morning, Frederick. Thank you.
Good morning to you as well. So over the past few years, we've seen more and more of a concept coming up in investing called factors. Tell us a little bit about this. Is this something that we should be knowing about?
Yes, it is. It's these are what we try to discuss on these segments is basically ideas to help people grow their money faster. And so the idea of factors is one of those new kind of terminologies that exist as far as in our industry, and it's basically trying to give people a heads up as far as trying to outperform the market. So this first slide is terrific because what it's doing here is it's basically saying there's roughly 400 identified factors that come into play as far as in investing, 771 factor funds. These are ETFs, these are mutual funds that you can invest in, over $1 trillion in assets that exist in this. So this is big, big stuff, and again, important stuff as far as to, again, give people upper hand as far as investing their money.
Yeah, so that's right. It's a great segue into the next question. How can these factors be used in those investing decisions?
So slide 2, again, I love visuals. I think other people out there love them too. I think it makes it a little easier to digest. We're looking at here the S&P 500, but what we've done is we've broken it out as far as into two segments. One is the value play, the other is the growth play. Growth typically is implying like technology, things that nature. Value is typically going to be kind of old school type stuff as a general thumb, not always, because these things move a little bit. But what we're looking at is in blue is the growth approach. So again, technology as far as for this period, we're going back to 1996, folks. We're coming up here to current times, 2019. And what we find is that during this period, that growth is on a gross basis killed value during this particular period. However, there's various periods in time here where value actually outperformed growth. So again, this is one of the strategies. There's times I'd want to be in growth, there's times I'd want to be in value, and this is visually showing us that there are distinctions and people can take advantage of this to try to improve returns.
Yeah, that seems to be the common ones, growth and value, but what about some of those less common ones? Are those useful still?
They are very useful, and the next slide we'll walk through that. This one is a fantastic slide. You look at this visually. We're looking at high beta. What is high beta? High beta is going to be something that is a relatively aggressive stock. It's going to move higher, more when the markets go up, and it's going to move more when the markets go down. And then we're looking at low volatility type stocks. That would be in red. So again, that's a safer path. This is a more adventuresome path, but at the end of the day, certainly the high beta during this particular period of time is outperformed. Now, the point of all of this is to basically create a portfolio that may have this at certain times in the portfolio and this at certain times in the portfolio. And again, with proper tools, that's the goal. What we're attempting to do is to try to figure out where we want to be at various points.
Great stuff as always, David.
Thank you.
For coming
Appreciate
in.
it.
All right, and if you missed any of our conversation, we'll put it on our website for you. That's our quadcities.com.